Hello, I'm Lindsay Hall, Chief Market Strategist for the RMB Group. Welcome to our video series, A Short Course in Futures and Options. In this lesson, we will cover the basics every options trader needs to know. Let's get started. We will begin by discussing the concepts of call options. The call buyer wants the market to go up. The call buyer pays money in exchange for the right, but not the obligation, to buy the underlying instrument, stock or futures contract, at a specified price for a limited period of time. The call buyer is like the land speculator in our example. He makes money only if the underlying market goes up. The call seller doesn't want the market to go up. The call seller receives money in exchange for granting the right to buy to the call buyer. The call seller has an obligation to sell the underlying instrument to the call buyer at a certain price for a limited amount of time. The call seller is like the landowner in our example. He makes money if the underlying market does not go up. Note, the market does not need to go down, it just can't go up a lot. Now, let's move on to put options. The put buyer wants the market to go down. The put buyer pays money in exchange for the right, but not the obligation, to sell the underlying instrument at a specified price for a limited period of time. The put buyer is like the homeowner in our example. He makes money only if the price of the underlying instrument goes down a lot. The put seller doesn't want the market to go down. The put seller receives money in exchange for the obligation to buy the underlying investment from the put buyer at a specified price for a limited amount of time. The put seller is like the insurance company in our example. He makes money if the underlying instrument does not go down. Note, the underlying instrument does not need to go up, it just can't go down. Now that we have the concept of calls and puts, let's move into the terminology aspect of options that will be fundamental in your learning. The underlying instrument. What you have the right or the obligation, if you're an option seller, to buy and sell. It could be shares of stock, foreign currencies, or a futures contract on crude oil, gold, or soybeans. An important point, no matter what the underlying instrument, options work the same way. They are all affected by the same factors. The premium is the amount you pay when you buy an option and the amount you receive when you sell an option. The expiration date, the date that the option expires. It's important to know the expiration date because time until expiration is a major factor in determining an option's fair price. An option is known as a wasting asset. It loses value with the passage of time. The strike price, the price at which you can exercise your option. This price is based on the underlying instrument. Call option buyers have the right to buy, and call option sellers have the obligation to sell the underlying instrument at the striking price. Put option buyers have the right to sell, and put option sellers have the obligation to buy at the striking price. While we are on the topic of the strike price, let's also discuss some descriptions that you will hear often with regard to where the option sits currently. First, in the money. Calls are in the money if the price of the underlying instrument is higher than the striking price. Puts are in the money if the price of the underlying instrument is lower than the striking price. Using our crude oil example, a $70 put is in the money with crude oil at $45. Puts are in the money if the price of the underlying instrument is lower than the striking price. Using our crude oil example, a $70 put is in the money with crude oil at $45. Second, at the money. The price of the underlying instrument is identical to the striking price. Same for both puts and calls. Third, out of the money. Calls are out of the money if the price of the underlying instrument is lower than the striking price. Puts are out of the money if the price of the underlying instrument is higher than the striking price. Again, using our crude oil example, a $70 call is out of the money if crude is at $45. To visualize, a $70 call is out of the money if crude is at $45. You have now finished our 5th video in this series. Our next video, Options as Insurance, will help you understand how you're able to insure against the loss of opportunity, as well as understanding the three major factors that determine the price of options.